Thanks, Michael. Thanks so much for those kind words. Thanks, everyone. So today we are going to make it a little bit less technical, a little bit more practical, just to give you a flavor of how the revenue authorities across Africa are looking at certain transactions, which I think is quite interesting, funny sometimes too. But generally, I would say when we're looking at considering transfer pricing issues in Africa, you need to look at Africa not as one country, but 52 countries, right? With different rules, different laws, different practices. And ultimately, there's always a gap between legislation and practice. The revenue authorities across Africa generally do not follow the letter of the law, and they would always try well, not always, but there's a high probability that they'd choose the alternative that's going to give them the most amount of revenue. So those are the obstacles that you're up against. If you look at 2004 and you compare it to what's happening currently, in 2004 there were only 2 countries in Africa that had transfer pricing legislation. We're now looking at the majority of countries that have their own TP rules in place. So that already tells you that there's a lot of movement within the revenue authorities themselves. They set very ambitious revenue targets. They're driven by things like an increase in foreign direct investment in certain industries, for example, the extractive industries. There's a lot of cooperation regionally between revenue authorities, which obviously makes it easier to exchange information, to share knowledge, all of that. There's a lot of cooperation, technical support, capacity that's provided by development partners, such as the OECD and DFID. And then, of course, there are certain civil society organizations that actually would propose or advocate transparency, which all in all, you know, just drives the behavior of more aggression, more activity, revenue targets, all of those things. So the key issues that we face when we look at transfer pricing in Africa currently is that most countries don't follow the OECD transfer pricing guidelines. And very few countries, in fact, consider the UN transfer pricing model. So as you can see, it's all over the place, right? So that's the first thing. Then you have very few safe harbors, so you can't rely on anything that's going to give you some level of safety. There's a lack of local comparable information. There's lack of an understanding as how you would adjust foreign comparables. There's generally lack of guidance on how you would apply the transfer pricing legislation in country. There's obviously the whole concept of very high withholding taxes, as we know, and corporate tax rates, the opportunity for double taxation because of a limited treaty network. We're sitting with a situation where if revenue authorities make an adjustment, there's very high penalties and interest. Exchange control is an issue in terms of flow of funds. There's lack of understanding or certainty as to the choice of methodology across Africa as it relates to royalties, management fees, and other service charges. So all in all, it's very challenging. The issues that are also quite pertinent to think about are the transaction taxes in terms of withholding tax and VAT, which is very important to consider when you're looking at your transfer pricing planning into Africa. So, and the other issue is because of the very high levels of economic and political risk in Africa, it becomes very challenging